We are live. Well, sort of. You're not listening to this live, but Jerry and I are live to the both of us.
We're alive.
We are alive too. And it's the Long Only Podcast.
And he's
And
Doug.
He's Jerry. His name's on the firm. Mine's not. So, Jerry, what's been up?
Well, it's interesting because the market has been up and setting new highs. And I think it's been quite misleading for most people who aren't regular observers, because I think there's this perception that things are hunky-dory in market world, when in reality it's being driven by a very few number of companies. I think we've talked about this.
We have. Yes.
I'm sure we've talked about it.
I call this incumbency because it's jargony.
It's an incumbent problem. And I don't let me preface all of this with, I don't have any problem with large, gigantic, huge, massive companies, as long as they're not being given a pass or given special treatment from government. And I don't think that's happening in most cases. The company of the day is clearly Nvidia. It's the most important semiconductor company in the world, making graphics processors, which are extremely powerful processors, very expensive and in short supply. And Nvidia is crossing into a $2 trillion market cap. In full disclosure, we owned Nvidia for about 17 years, did very, very well with it, sold it in 2019 or 20. At a significantly lower value than it is today, but we still made something like 42 times our money on that. So I think we sold it around a $400 billion market value. So, it's quadrupled since then, but when you're up 40 something X in 17 years, you decide maybe it's time to move away. And when a company gets to be $500 billion or thereabouts, for us, it's too big for us and in our growth strategy. So we have no chagrin about our selling Nvidia, and it's continued to be extremely important. And this is what we thought Nvidia would be. It's why we bought it and owned it for so long. And by the way, in the interest of describing patience in investing, that 17 some odd years that we owned it, and there was a period there where we actually owned it maybe 7 years and sold it because we were frustrated because it wasn't going anywhere. And then fortunately bought it back fairly short after and realized, this is a mistake. We got to hang in there and stay with it. And I think we paid basically the same price we sold it for maybe a year later. So it's a 17-year period of time with a little break in there. But it wasn't until the last 4 or 5 years that we owned it that it actually exploded. And how many folks, professional money managers included, would not have given a company that much time to come to fruition. And so I would say, accuse us of cherry picking if you want, but that's one of our great successes in my career was hanging in there with a company like that hadn't done very well, or just hadn't done enough, if you will, for like the first 10, 12 years that we owned it. And so much so that at one point we lost faith and got out, and then panicked and got back in. But then it still took 6-7 years for it to come to fruition. And then when it did, it was just amazing, and it's continued to be amazing. And it's driving a lot right now. I mean, heck, the other day when they reported earnings, and they had just a bang up earnings, amazingly good earnings. It was a market driver. But what we have is, we've talked about that magnificent 7, maybe it's 10 companies that are such a significant percentage of the movement in the S&P 500, which is so broadly considered the quote unquote market. The fact is most companies are not participating in that. And we are, in our portfolio, our growth portfolio anyway, we've participated on the income side, which is interesting, over the last couple of years, but not on the growth side, as it's been underperforming the very mega cap big tech names. And in fairness, they finally got big tech right. Nvidia is clearly a technology company.
It's not
we've always taken
technology company or media company masquerading as a technology.
Correct. Company. We've always made that. It's clearly a very, very good technology company. And Jensen Huang, the CEO. I remember, I think when we were first doing due diligence on it, it was late 90s, and going and seeing him in an analyst meeting and coming back to my team and saying, that's a guy I want running my company. I mean, he's just a phenomenal manager. Now, it's different when it's a $2 trillion company than when it's a, $400 million company. And he's been able to, obviously prove that he can manage a gigantic company as well as he did a smaller company. Kudos to him. And we need to point out, great managers when they exist. You hear all about Elon Musk and, or Steve Jobs. Jensen Huang is not necessarily a household name, but he probably should be. He's just really done a great job. Just wanting to point out that these new highs in the market are being driven by a few companies. We really need to get that broadened out. And after 5 years or so of significant outperformance from our more smaller, growthy companies in our growth strategy, I've had a couple of years of underperforming. I think that's going to change because that's been so driven by interest rates and inflation, and which is the worst we've seen in 50 years, 70s. Is that 50 years? And I think we're getting past that. As we've said, I think we probably risk interest rates pushing too hard on higher interest rates, pushing too hard on the economy, and probably creating, more weakness in the economy than we would need to have because of that. When I say need to have, you never need to have it, but the policymakers who think that economic growth, people working, causes inflation, which is nonsense. Nonetheless, they're probably going to at least slow the economy more than it would have otherwise been slowed had we not had now these higher interest rates. And in and of themselves, I mean, we were arguing for higher interest rates for years when we were at 0% interest rates, and here we are now finally getting higher interest rates. And we're saying, well, geez, they shouldn't. They've overdone it. Well, it's because they've been asleep at the switch for so long with 0% interest rates. It's kind of like, okay, now you're doing it at a point in time where the economy is more susceptible. And, more than anything, what's horrible about it is they think they have to slow the economy to stop inflation. If we aren't once again proving that economic growth is not a driver of inflation, I don't know what more we need than what we're seeing right now. The economy has continued to grow, albeit slowly, in what it was a ridiculously high inflation environment, and now inflation has kind of started to wane a bit, and it's hard because so many people are still paying so much more. For all of us are paying so much more for basic items. Well, that's what happens when you have the kind of crazy jump in inflation because of massive spending from government. That's what happens. Unfortunately, it's not likely to come down. That's the really sad thing. And I think we're about to hear, maybe is it tonight? I'm telling you what day it is, right? State of the Union. I think Uncle Joe's is going to give a State of the Union address, and so reportedly he's going to trash companies for shrinkflation. Putting fewer potato chips in the bag as a means to get away with jamming people for more profit.
Well, it's an annoying thing nonetheless, but probably not the thing the president should be focused on.
No, and not the cause by any means.
Yep, exactly.
It's your spending that has done this, knucklehead.
I think I'll be watching old Schoolhouse Rock videos on YouTube. They'll be more educational and have a better time. So.
It's Lent and I'm not watching TV, so his State of the Union will be one I'm gladly not going to watch. Anyway, so you asked a question about the market, and here I am on a diatribe.
I think I said, "How's it going?" and that was 10 minutes ago. But I do want to get into something.
Where it's going is it's making new highs. Where it's not going is it's not enough companies are participating in that.